For many who choose to purchase a home loan is probably the largest and the longest term loan they'll be responsible for during their lifetime, and probably the biggest asset they'll be buying with that loan, which is a home. When taking on a loan for a home, you promise to repay the money you borrowed at an agreed upon interest rate and terms, with the home being used as collateral until the loan is paid in full. This means that if you break the promise or agreement you made and signed upon the terms at closing to repay your home loan, the bank or the investor who owns that loan at that time has the right to proceed with the foreclosure or the process of it on your property. Now, many buyers aren't aware that your loan doesn't become a mortgage until it's attached as a lien to the property, meaning your ownership becomes subject to you paying the loan on time as agreed upon at the time of accepting the terms of that specific loan. The more you understand about the home buying process, both short-term and long-term, the better prepared you will be when making decisions when the time comes. If you are looking to leverage a loan in the purchase of your first home, or maybe even your next home, one of the more important decisions you will need to make or will be making is selecting what loan and terms are right for you. Few buyers understand how a loan works and what role they play in the process overall, and even more don't know how to best leverage their finances or debt in general in order to put themselves in the best position when buying a property. And also, one of the main reasons why I made this video. We will go over the economic life cycles as well as the big picture of how a loan works from A to Z and what role as a buyer or homeowner you play in the process. So let's begin.
So before we begin everything, I did want to go over the economic cycles and basically how the economy functions. Just a bird's eye view of everything, just so you have an idea as a home buyer of where we are at, what the economy continues to do as it always goes up and down. And we'll quickly discuss where we are currently at in the economy based on the date that this video was recorded, because this does affect how institutions lend to you, as well as the type of rates you will get, as well as the inventory and supply and demand, not only for homes in the marketplace, but for everything else, loans, cars, products, commodities, everything that we use in our daily life. So the cycle kind of begins or keeps going in circles. And this goes up and down. Sometimes the markets hold here for an X amount of years. Sometimes they go up and down within the same year. But overall, it's a circle that keeps going up and down, that has pros and cons of every cycle that we are in. And there's benefits and the negatives of each one. So right now, kind of where we're at in the current economy is low interest rates from banks, which then pushes the economy for businesses to grow with jobs being created and, or guess, more opportunity. Personal wealth increases. People buy homes like they are doing now. The supply of homes is very low because interest rates are low, because people are getting new jobs or they're getting raises and they're able to put that money towards a home, and their purchasing power goes up, not only for homes but in things in general. But this is also the negative of inflation happens. The more money there is in an economy, the more inflated it is, or I guess the more amounts of that money is, which then lowers that purchasing power, whether it's a dollar or anything else. So right now, well, personal wealth increases. People are buying homes, which we just discussed. Inflation, money supplies grows, and the value of the dollar drops. So we're kind of here right now in the current economy from the time that this video is being recorded. And then, there will come a time, as we are already on the cusp of it, where interest rates will start to rise. Lending will be limited, or will not stop, but will be not as aggressive as it is now, and a recession will begin. And then we'll be here for an X amount of time. We have been in this kind of swing for the last 10 to 12 years, and this is why consumers, home buyers, especially first-time home buyers, are used to low interest rates, where rates are at 3, they were at 2 during the virus. So it has created this false expectation that interest rates are this low always, which is not true, because interest rates truly are between 5 and 7% historically when you look at the data. So as we get to this time, as interest rates are closer to 4 now, and I think heading into 2023, we slowly move into this cycle of the economy. We will see what happens, but basically this is the circle of the economic life cycle. So understanding this, where we are at, is a nice way to start, because you need to know where you're at, how this affects your lending, and what type of market you're in will definitely put you ahead of a lot of other consumers in the marketplace, especially when it comes to getting a mortgage if you are doing that for a home, because it is a large amount and it's influenced by interest rates, economic factors, and your personal qualification factors. So all these things come into play, and if you want to put yourself in the best position to get the, I guess, leverage the position that you're in, this is something that you should be mindful of when going to get a loan, even before going to speak to a mortgage lender or mortgage broker. Um, this next chart is kind of the bulk of this whole presentation, which is, the loan life cycle. I go over this with all of my buyer clients. Not many understand this. Not many know what role they play in the process as a whole. Many people and just consumers in general, not their fault. It's the way we've been raised and how things have been marketed to us. Feel that, you go to a bank, you get a loan, and then whatever loan you get, you should buy at your max approval. And there's not many people within the industries of lending and real estate, agents or the sales side of real estate, who truly also don't understand this process, to be honest with you, which I think they should, because as agents, as lenders, mortgage brokers, real estate brokerages, it is our role to be educators, to educate people before they make a decision. However, that's not always true in this industry. It's an industry where people feel that people should understand this. Some people don't understand it themselves, so they can't teach it. And a lot of times, and this is the result, that the failure rate is so high in these industries because people just don't know what they don't know. Only those who take it upon themselves to understand this process and educate others are successful, and everyone else kind of becomes more transactional, where it only comes down to, just closing a loan or closing a sale, but it isn't really centered around the service and the education and just the process overall of how you educate a consumer, which is something I deeply care about and something I always go over with buyers. So some of them find this boring, some of them don't want to know it. However, I feel that this is something, as a consumer who's taking a mortgage for X amount of years, whether it's 5, 7, 10, 15, or 30, if you don't understand the product that you're taking and what you're signing, you only have yourself to blame in the future should anything happen. And you need to leverage all this information to put yourself in the best position. And this video will kind of go over that, what you need to do before you even go speak to a lender, of how you leverage your position to put yourself in the best spot to get the best rates and the best outcome over the long term. So this chart overall just goes over the loan life cycle from A to Z. We'll focus more on, as a homeowner, what role you play in this process, and I'll explain to you what is what, why this is this way, and what you should, as a homeowner, be focused on when you go speak to a lender, the things that you can prepare for before going to speak to someone. So the overall picture, this is more of a bird's eye view conversation. A lot of these things should be covered by your mortgage broker. It's things that they should be explaining to you. But there's also some personal accountability that you should be taking upon yourself as a home buyer to understand this, because if you're going to a mortgage broker, their job is to give you a loan. So whatever information you bring to the table at that time, they will approve you based on that. Not many, if any. There's a small percentage that will actually go into the details of, like, hey, you should improve A, B, C, and D. And the first tip, I guess, through this video is, before you even go speak to a mortgage lender, I think it's wise, because a lot of misinformation in this industry is about, you want to buy a home, go get pre-approved, which I believe is false personally. I think it's, you want to buy a home, go speak to a financial planner. If you don't already have one, they will help you see the bigger picture of your money overall, not only for a mortgage of a home, but they will explain to you what your financial situation looks like if you are not doing that yourself already. They will go over with you the rules of thumb of how much you should put down for a home when it comes to a mortgage. And then if there's any debts that you have, you should work, I guess tip number 2 is to minimize or pay them down to an amount that will give you favorable terms whatever loan you're getting, car loan, home loan. So I think personally for me, the first steps are, go speak to a financial planner if you don't have one already. 2, minimize your debt. And then we enter step 3, which is this, understanding the loan life cycle and how you play a role in it to get yourself the best loan. And the way lending works in general, one of the biggest misconceptions I think buyers, or I hear buyers don't understand, or the way they explain it, is that I went to the bank and they gave me a loan, and now I'm going to buy a home, whether that's 500, 600, 1 million, 2 million, whatever that amount is. And that's one of the biggest misconceptions. The banks, just like you, have guidelines to qualify. So banks, actually, this is your local branch, which wherever you bank, whether it's a credit union or a big bank, or wherever you choose to bank, the branch you go to take out money on your ATM, they lend from government-backed institutions or government-backed banks, which is kind of where this whole process starts. Now, these banks don't have branches and corner stores where you can go into and save your money, because they don't deal with consumers. These are institutional banks that deal with banks only. And if you've heard in the past that, interest rates are close to zero, it's the federal funds rate, which is the rate that banks lend from the government, and then in turn they lend that money to you at a percentage rate. So there's a lot of misconception when the rates were close to zero or at 0.25%. Many buyers were calling me saying, I'm going to hold off because now rates are zero. And that's the first misconception that exists. What these banks are paying for the loan is not what you or we as consumers pay for the loan. And that goes for everything: cars, credit cards, home and auto, everything. So banks, during a time like this, where the economy has low interest rates, yes, the government-banked institutions lend to banks on the secondary market at a discount. It is closer to zero. I'm not sure exactly what that amount is, but it is closer to zero. And then these banks now, they make sure that you as a homeowner qualify for the specific guidelines that these institutions look for in order for these institutions to then fund your loan, if that makes sense. So this is why, going back to you as a homeowner, when you go speak to a mortgage broker, there are specific guidelines you have to meet since 2008, since the recession where everything crashed on the housing end, and that is that you do have to have a certain credit score. There is certain debt to income ratios that you have to meet. There is certain credit score requirements that there are definitely more guidelines today when it comes to lending than they were in the past. It was more of a Wild West. But today, in 2022, if you're looking to go get a loan, there are certain guidelines that you will have to meet, or you will not be able to qualify for those loans, which is a good and bad thing. I think the good thing is that there's more transparency in lending. The other good thing is that you have a little bit of control over the process, as far as what you can prepare yourself to qualify for to get the best loan. Or whatever terms that you want to get. Because if you do not qualify for some of these guidelines, you will have higher interest rates, you will have higher closing costs, and it's at that time you have to decide, is buying a home today for me the right thing, or should I hold off a year and correct some of these things that I can control, like my credit score, like my debt to income ratio, like maybe holding out at the job for another year to have more of W-2 income in order to put myself in a more favorable position to buy a home. But if all those things check out and you qualify for multiple loans, then you speak to your mortgage broker. He collects information from you like W-2s, tax returns, 2 years of all those criteria. He then makes you fill out a loan application verifying your employment and all those things. And then this bank who is lending to you now shops this loan from day one to these government institutions. They say, hey, I have a client, Jack and Sally. They are making $850,000 a year. We've qualified them for $1.2 million based on these terms. They are able to put 20% down. Whatever those terms are for the loan, it's all subjective to the house you're buying, what type of loan you're getting. Is it a adjustable rate mortgage? Is it a fixed mortgage, which is what most people get when they buy a home, usually a 30-year fixed mortgage? But there are other mortgage products if you're buying homes over $1 million or for more, like jumbo loans, that may be different for the property that you're buying. So it doesn't really change much anything else in this process, but it does change the approval process for you. So from day one, when you apply, these banks that are lending to you, or your loan officer or mortgage broker, already has an idea of where your loan is going, who is going to be purchasing it, and they are now formulating and putting that loan together to make sure that the loan meets the guidelines and you meet the specifications. And when it comes time, when you find a home and the final underwriting happens, you will be qualified and approved for that loan to purchase that home, and then that home can be funded through this institution, who then gives the money to the bank, who then lends the money to you. So this covers the first phase of the process, and that is getting approved and actually buying a home. If you get that far in the process, What happens later is the payments, how they're distributed, who deals with your payments, because it's not government-backed institutions. These banks don't accept payments from consumers, neither sometimes the banks, because if you close your home on a Monday, that Friday or maybe a few weeks into your ownership, that note is then sold off to maybe a larger institution, maybe some private investors. And I always give people the example that just like people flip homes, they buy a home at a discount, add value to it, and then sell it. This is what banks do with mortgage notes or mortgages overall. And they sell them they flip the note and make the money that they would have made in 5, 7, 10, 15, 30 years, whatever the terms are. They make that today, and they give another a lender or private investor the opportunity to collect that interest over time. Now, as a homeowner, this doesn't change anything on your loan. If you secured a 3.5% loan for $550,000 over 30 years, it changes nothing, because now we're going to get into your monthly payments and who you actually pay. Because every time you take out a loan, you don't pay directly to this bank. As we mentioned, you pay a servicer, which is basically like a middleman or a middle company who services your loan, basically. So they're the ones responsible for collecting payments for you. They're the ones responsible for keeping money in escrow, meaning your taxes to be paid at the time they are paid. And most homeowners pay one time or pay once a month for all these things, which are lumped into their loan. There's a very small percentage of homeowners who pay their mortgage and then they have to pay their taxes somewhere else. Usually it's a one-time payment, which is then paid to the servicer, and it's their responsibility to distribute it, for it to go to taxes, to go to interest, and to go to your principal and pay back these two players, which is the government-backed banks and the bank that funded you the loan. So you're dealing mainly with the servicer, and sometimes when you purchase a home, a month or two in, you may get a letter, or if you're a homeowner now and you've gotten one in the past that says, hey, your loan is now serviced by ABC and D company, whatever that company is. It doesn't change anything on your loan. It just means that this person in the puzzle has changed, meaning this servicing company does not service your loan anymore. And usually when you get a letter like this, it means that one of these government-backed institutions has sold your loan to another investor. So that's basically how those things work when you get a letter like that. It's common. It's more common in an industry like this where lending is very high. There's a lot of lending happening. A lot of people are getting mortgages. It's a very active industry when it comes to homes. So these things happen and mortgages are being traded. So this is very common that it happens. Now, when that does happen, when all your monthly payments are sent to the government-backed banks, that happens for the term of the loan that you take, 15, 30 years, or until the completion of your loan. After that, when you pay off your loan, you now get the deed to your home or the title, and you don't have to pay a mortgage anymore, aside from your taxes, maintenance, and all those things that come with homeownership. But that's kind of the gist of how a homeowner gets a loan, how it's funded, how the payments are made. And then the more general picture of how this ties everything back together is that your loan, your neighbors, and everyone else's loan that might qualify for the same loan terms is now lumped or bucketed or pooled into a large, more investable vehicle known as a mortgage pool or a mortgage-backed security. To explain this bottom part is getting into how the stock market works and what investors invest in. And one of the vehicles or things that are investable is mortgage-backed securities, which is a pool or a X amount of mortgages that are pooled together into a fund that are now investable and give a return based on the ability of the homeowners to pay back their amounts. And going back to 2008, when everything kind of fell between 2008 and 2010, this is the reason why that happened. It was because lenders didn't have any guidelines to follow. They were lending out to people who weren't qualified for loans with some creative underwriting tricks just to kind of get the loan to close. The loans inside of these mortgage pools were not what they were thought to be, meaning these weren't A-plus lenders. These were people who, yes, there was a few good loans in the pool of maybe say 100 or 1,000, but the majority, 70, 80, whatever that percentage was, were not good loans. It was people who weren't qualified to pay over the long term. It was people who maybe have already started defaulting on their loans. And a lot of the economy overall started investing in mortgage-backed securities. And even you yourself, if you have a 401k right now at your job, if you open that up and look through there, you will see that some of the things that your money's being invested in, I'm sure there's a section, depending on how aggressive your portfolio is set up for your 401k, there is a section that talks where your money is probably invested in some of these vehicles like mortgage-backed securities. Now, might not be all of your money, and it might not be a big percentage of it, but 401k kind of puts your money in diverse areas of the industry, and one of them is this mortgage-backed securities pool. So you had people that had 401ks heavily invested in this mortgage-backed security type of product that did lose their 401ks, and this is one of the reasons why, because they were either being guided incorrectly by their financial planners, maybe their job was heavily invested in this because their returns were so attractive, so people lost their money. So just like I said in the beginning of the video, to go speak to a financial planner when you buy a home, it's also important, which is like a side note, not even related to housing, to kind of know what's in your 401k, where the money is going, why it's going there, and to understand the bigger picture of everything that you're investing in, because you have a lot of control over a lot of these things. But going back to this, now all your loans and everyone else who gets loans are now pulled together, and they are now made tradable for investors on the stock market, whether it's a fund or some type of investable product where companies, you yourself, can individually invest in these products and monitor how these, I guess, pools of mortgages are doing. But this is a broader picture of the economy as a whole, of how you as a homeowner just getting one loan plays a big picture into the economy as a whole. And a lot of homeowners, as you could see, we have an example from 2008, 2010, when everything collapsed from the housing standpoint, how one loan can turn into thousands of loans or millions of loans that default and really crash the economy. And this is why now, since that time, there has been more guidelines put in place. There is more, I guess, checking and verifying that is done, which I feel is right. There's more transparency. There's more information available today. And the real estate industry overall, from my standpoint, there is more transparency in it. And I believe it should be. Real estate is not done the same way that it was done 20, 30 years ago. Consumers and buyers are more smarter today and more educated if they want to be today, because this information is public to everyone. You just have to either have the right person guiding you who understands the data and lets you or helps you interpret it, because there is a lot of people, even mortgage lenders or real estate agents, who don't understand this process well, and then in turn they are guiding people who also don't understand, and it becomes more of a blind leading the blind type of approach, right? I think the person you choose to work with from the mortgage standpoint, just like the real estate agent standpoint, just like the attorney you work with, just everyone overall who you have control over picking in the process as a homeowner, is very important, because they're your team that you're picking, and they're like your coaches who will guide you to the best, I guess, destination. So if they themselves don't know, I think after watching this video, if you are more educated or didn't know a lot of these things, I would reach out to your real estate agent and mostly your mortgage broker to go over all this and make sure that they also understand this. They're the ones that you're, I guess, entrusting with giving you the best terms and rates and the best mortgage based on your qualifications. So if they don't understand it and you know or understand it better than them now, that's a huge red flag, right? Your lender should be the one educating you about this process overall, how that affects you today, when you purchase, and the bigger picture 5 to 10 years down the line. So I hope this helped. If you have any questions, of course, you can reach out to me at the bottom of this video, or feel free to reach out. My information will be there as well. Feel free to use me as a resource, of course. And any questions regarding this, or just to personally go over this, we could definitely schedule a time to go over that as well.
I hope this helped in understanding the loan process and gave you a good perspective of how your mortgage works, as well as the role you play in the process as the borrower. If you're looking to buy or sell your home now or in the future, I'd love to be a resource for you. So follow along and find out more by clicking the link below. And feel free to schedule a time so we can discuss your options so you can put yourself in the best position when that time comes.